During a bull market in equities, a large number of new investors tend to enter the markets. But then the weather within the equity market tends to change, and a bull market is followed by a bear market, which is what we are seeing currently. And that is when a sort of weaning out tends to happen. Though it has not happened on a very big scale in this bear market, but there are fears that this is what we may see if this trend continues for much longer. To tell us about some of the excesses that we may have committed during the bull phase and the kind of course correction that we need to do during this bear phase of the market, we have today with us Vishal Dhawan. He is CEO and founder of Plan Ahead Wealth Advisors, a Sebi-registered investment advisory firm, and he will talk about some of the adjustments we need to make within our mutual fund portfolios to find our way through this bear phase. Welcome to our show, Vishal. A large number of retail investors joined the equity market during the previous bull run from March 2020 to around October 2021. Now we are in a bear phase. So I thought I would ask you how retail investors can weather a bear market. My first question is, for how many years have you been doing financial planning, and through how many bear markets have you handheld retail investors?
Thanks for having me over, Sanjay. I think it's important to keep in mind that, bull and bear markets, first of all, get known in hindsight. It's very difficult to actually go out there and know it in advance that you're about to enter a bull market or you're about to get into a bear market. So one of the things that we all have the benefit of is history to go back to and see what was really one market which was a bull market and which one was a bear market. Having said that, we've seen at least, our business at Plan Ahead is now finished 18 years. So we've been through at least 3 very, very clear cycles of market downturns. And, each of those bearish markets have been caused by different factors. And that's something that I think all investors need to keep in mind, that very often, just like the timing of a bull and bear market will be known post facto, even the cause for that happening very often becomes post facto well known. And therefore, a lot of decisions that you need to make may have to be made assuming that you are not absolutely sure on whether you're going to be in a bull market or a bear market.
True. So which were the major bear markets that you have been through?
So the first one was actually the global financial crisis, where very clearly the trigger came from the housing crisis in the US, and it spread very quickly across the globe and took some large well-known institutions along with it. We then had a period of what I would call listless sort of performance for a period, and that culminated with a tapering process which happened in 2013. Once again, where you had both the rupee and the equity markets react very sharply to what was happening in terms of liquidity withdrawal from the US. And then we had another period which came in the about 3 or 4 years ago, where you had very, very clearly overvaluations, especially on mid and small cap sort of businesses that ended up not being such great outcomes for investors. The current one is the 4th one that we are going through live with investors. The reason why we don't count it as a bear market today is we haven't probably seen the culmination of it yet. We will again know it in hindsight. And my first experience for the bear market, interestingly, happened as an investor myself, and as a retail investor myself in the technology bust that took place in 2000 as well. So I've seen 5 bear markets in my view, of which 4 of them have been where we've been advising clients. One of them where we've learned ourselves as an investor what can go wrong. in bear markets.
So one was 2000, another was 2008, 2013, 2018, and now the ongoing one.
That's correct.
So during a bear market, investors often they fall prey to what is known as anchoring bias. What is this bias, and could you explain what it does to investors, what it means for them?
Yes, so anchoring bias is something that is very, very commonly seen across not just investment and investments, but also across our day-to-day life in various ways. For example, many of us would have had parents tell us that when we were young, something used to cost 1 rupee, it now costs 100 rupees. We ourselves probably are guilty of telling our children the same thing sometimes, saying that, things have become very expensive. When we were young, they used to cost 10 rupees, now they cost 100 rupees. So in the same manner, we also see the piece play out with investment strategy as well, or investment products that you may have invested in, where we tend to anchor very often to either a highest price point or a lowest price point. It's very common that when you're coming out of a bull market into a bear market, you tend to anchor to the highest price point. So it's not uncommon for investors today to say that, my portfolio is worth X a few months ago. Now it is worth 65% of X or 70% of X. And therefore, I've lost a lot of money. What they very often don't see is that maybe they had put in only 40% of X. And therefore that X, that was the point at which they reached, is not actually the loss that they have made. It's actually from 40 to 65 that you are today, which is your rate of return that you have generated over a period of time. During those periods, there have been points at which you have reached 100. And there have been points where you might have been 40 or maybe even a lower number than 40. And therefore, you need to be able to normalize this rate of return and this outcome as compared to just looking at it and saying that, oh, I have lost 30 or 40 rupees because this thing was valued at 100. Again, a space where this is very, very common is on real estate. And you often see that a lot of investors never really exit real estate at all because someone has mentioned to them that the price of the real estate that they have is, worth a certain value. Let's say your piece of real estate should sell at 40,000 rupees a square foot. Now, because they are not able to find anyone who's willing to pay 40,000 rupees a square foot, they really don't sell, even though they may need the money very badly. And the mistake that they make is that besides getting anchored to the price, they also don't have an independent way to validate what that price should actually be. At least in the stock market, investors can see that if there was a stock available at X price, and today it is at 30-40% lower, that's the price that many people are willing to pay if you want to sell. In a piece of real estate, you could end up finding that you're anchored to a price which has no real basis except for a comment made by someone whom you believe knows what is happening in that particular space.
Now, many of the troubles that investors face in a bear market often arise from their sense of omission and commission committed during the previous bull run. Now, what were some of the major mistakes that investors made during the previous bull run?
So there are three of them that I would highlight. Of course, there are many more, and we can probably do 2 days of conversation around the genesis of where the problems of a bear market actually come from. But one of them, which I think is topmost for most investors, is a recency bias. We all tend to chase past returns, and that's what very often makes us blind to to the fact that something could have become too expensive. without us realizing it. Because every time we look at doing an exit or we think about doing an exit, the price of that asset goes up even more. And because it goes up even more, we actually go out and thank ourselves saying that, thank God I didn't act. And this happens quite regularly during bull markets. And therefore you start to then believe that, this is the way it is always going to be. And therefore, let me not try to sell at all. So very clearly, recency biases, where again, you look at equity markets, you look at crypto assets, you look at real estate in the period of 2004 to 2014. All of these assets have suffered from a recency bias where people take the past few months or years of performance and extrapolate that out to the future forever, without believing in the fact that there will be a reversion to mean that will ultimately happen, driven by either global or domestic factors. The second thing that tends to happen is moving away from asset allocation and risk tolerance principles. You find very often that in bull markets, investors who have a risk tolerance of a particular type, let's say they're conservative, suddenly find that they are pressurized by what they read, by what their friends are telling them, by what their colleagues at work are telling them, or just what they're hearing around, saying that you seem to be missing the bus. And this missing the bus is a big challenge for many individuals, because no one wants to feel left out. As everyone says, the fear of missing out gets talked about very often in the younger generation, but we find that this fear is actually across the board and not just restricted to a particular generation of individuals or investors. The third thing is that rebalancing of portfolios, which means that selling when something has become expensive and buying something which is cheap instead, doesn't normally happen. What you actually find is investors can be very judicious with selling what is expensive with a stock, but what they are looking for is finding another stock where they can invest in, and therefore they don't change asset class at all. What ideally you want to do in asset allocation is that if, for example, equities have become very expensive, you want to sell a proportion of your equities and move to debt. Or if you find that domestic equities have become very expensive, you want to move from domestic equities to a part of your portfolio being in international equities. So those are the sort of things that we feel very often trigger a lot of challenges in bear markets. The one sort of additional item, which I think is something that we haven't yet seen in this bear market, but is very common across bear markets, is fear that comes in. So just like you have a recency bias of what has happened when things are going up and you believe that it's going to continue forever, there is every chance that you will do the same when things are going down, extrapolating that in. If you have lost, say, for example, 20% of your portfolio so far in 2022, then by the end of the year, this 20% will be 40%. By the end of next year, it will be another 40%, and so on and so forth. So the same recency bias plays out on both sides through a greed cycle on one side and a fear cycle on the other side.
So one key takeaway for all viewers from this, from what you just said, is the importance of rebalancing during a bull market, and the belief that markets will always mean revert, whether it is a bull market or a bear market. So investors must just hang in there. Now, Vishal, my next question is that in the international portion of their portfolios, most Indian retail investors invested in US focused fund. Now, in this market, the US equities have actually fallen more than Indian equities. And now many retail investors are actually regretting their decision to get into US focused funds. What would your advice to them be?
So again, our thought process on this is that you have to get your time frame right when you look at investments, especially on equities. Ideally, equity as an asset class is not designed for a 6-month or a 1-year sort of perspective. It is a long-term asset class. Wealth gets created when you invest in equities for 10 years, 15 years, 20 years. And therefore, when you see a cycle like we are seeing right now, where US equity markets have fallen, for example, it's not uncommon to see US equity markets lose 20%, 25% year on year. In fact, if you go back in history and look at data carefully, you will see that this happens with reasonable regularity. It is just that, again, because in the last few years, it has not happened, except for a very brief period when COVID hit. The expectation has been that, this is the new normal. A lot of people talk about, how this is going to be the roaring 20s. Because all assets are just going to go up, and therefore when you see a sharp correction, it suddenly goes back and makes you think about, is this what the roaring 20s was really going to be about? So I think it's very, very important as an investor for you to get your time frame right. And if you look at longer term data, you will see that US equities over the last 10 years have outperformed many other global equities over this period of time. And it's come out of periods where there have been other countries which have done much better. And then the US has done much better in certain periods of time. So again, winners rotate and these geographies rotate. So as an international investor or an investor embarking on international investing or just starting off on that journey, you need to be very clear about time frame. You need to be very clear about the fact that many of the businesses that are listed in the US are global businesses. What they are able to generate as revenues come from many other parts of the world, not just the US. And therefore, when you're looking at your international portfolio, look at it from the lens of the fact that you may be going towards a scenario where liquidity is getting removed across the world, where interest rates are rising across the world, where inflation is a challenge across the world. And therefore, markets in different geographies are reacting to the same information in a similar manner, but maybe to a different extent from each other. And it doesn't mean that this will also continue forever. So our recommendation is, don't give up on international investing because your initial experience has not been great. Go back and look very carefully at where you're investing. If you were investing into international investments which were beyond your risk tolerance, because, for example, you were buying say a NASDAQ fund, which was very, very loaded towards technology businesses, then you have to ask yourself saying that, did I really want this to be my first exposure to international investing, even though it was in the US? And therefore, should I be shifting to something which invests in the S&P 500? Or should my choice be something which is even more diversified, looking at the US as one of the components and also having exposure to other parts of the world like Europe, Japan, Asia, etc. So the advantage that you have as an investor today is you have multiple options available, and you also have the ability to stagger your entry in. I think that's another learning that I think a lot of investors should take away from bull markets and bear markets, is that when you're investing, because you will never be able to predict the top and the bottom, ensure that you have a steady flow of money that keeps going in through an SIP or an STP process, depending on your income flows, so that you can buy when things are more expensive and also buy things when they're cheaper, besides the discipline that it inculcates as well.
So on the product side, you said if you are in a concentrated index such as the NASDAQ 100, shift to something like an S&P 500 or into a world index where you are diversified across geographies. And you said that stagger your investments so that you average out the cost of purchase. Now we'll talk about small cap funds. These funds have fallen much more than most other categories, barring, I think, sector and thematic funds. And typically retail investors tend to take a lot of exposure to small caps during bull runs. What would your advice to investors be who have perhaps become overexposed to small cap funds?
Again, what you're mentioning is very common, that there is a recency bias in bull markets. Small caps and small cap funds tend to do much better. I think very often the mistake that we see is that investors look at best performers over a particular time frame and then buy the top 2, 3, 4 of them. And all of them may be from the same category. And therefore, when things go wrong or markets correct, all of them fall very similarly. So it's important that when they're making choices, they end up looking at categories very carefully and then picking one fund or at the most 2 schemes from there, rather than concentrating their portfolio across multiple schemes from the same category. If they have bought small caps, what they need to keep in mind is that small caps have traditionally had much higher volatility. And therefore, because of this higher volatility, the ups and the downs get accentuated when they happen. But they also tend to normalize if you have a long enough investment horizon. So one of the things that you would want to definitely do is ensure that if you were investing in equities with a 10-year investment horizon, then when you're doing small cap investing, you think about 15 years as your investment horizon. This is simply because a lot of the money that gets made off small caps happens as small caps migrate from becoming small to mid-sized, and some of them, of course, become large. And what you're doing with a fund manager is you're giving him the money to be able to try to identify which of these businesses are likely to be able to make that transition and become larger. If you look at the last, if you go back to 15 or 20 years ago, you will see that many of the stocks that today people feel very comfortable with owning because they're large caps used to be small, then they migrated to mid-sized, and then they've become large. And therefore, we would not suggest that you just exit small caps right now if you have it in your portfolio. But you need to be clear that I can deal with the volatility. If I can't deal with the volatility, then I should exit. If I think that I understand how small cap investing works, then I allocate maybe between 10 and 15% of my monies to small caps. And also, once again, I allocate them gradually rather than all together, so that I get the benefit of being able to buy over a period of time. Don't make the mistake of stopping your SIPs, because I think one of the things that happens is the moment you start to see big losses in a portfolio, the first sort of reaction is fear, and say that, let me not put any more money in at this point. I think what you have to do is you have to be able to continue this journey as long as you keep your overall principle in place, which is 10 to 15% exposure to small caps.
So continue with your SIPs and STPs into small caps. Have a 10 to 15-year horizon when investing in them, and have a 10 to 15% allocation to these funds, and you should be fine. Okay. Now, within each fund category, we have seen that some funds have fallen more in this bear market, some have fallen less. Now, investors want to migrate from funds that have fallen more to funds that have fallen less. Should they do so? What would your advice to them be?
So we do see a very large sort of disparity in performance, which tends to happen during these periods of time. And this could be coming from various places. It could either come from sector selection, or it would come from stock selection. What we believe is important is that when you are looking at these disparities, you look for long enough time frames, because there could be styles that particular funds follow, which could have done extremely well during one market period and which could do very, very poorly in another market period. And as an investor, when you look at your overall portfolio, you need to have multiple styles of investing in your portfolio, not just one style. For example, you will find that over the last 12 months, many of the value style funds have outperformed the growth style funds. Now, if you looked at that as the parameter and say, okay, let me identify those that have done much better, you could end up tilting your entire portfolio towards value and then not be able to transition back when growth style investing comes back in favor. Again, the same principle of mean reversion tends to play out here as well. And therefore, we would say that by default, a significant outperformance of one fund against another in a 12-month time frame should not trigger that decision. But yes, if that performance is there, the gaps sort of remain for long periods of time and there is no turnaround that is visible, I would say at least 3 years is what you need to track once you've bought in. Then you may consider whether you want to move your money from one space to another.
So you have told us something very interesting, that not only should you be diversified across asset classes, equity, debt, gold, you should also be diversified across sub-asset classes, large cap, mid cap, small cap, and then also across styles, growth and value style, because most investors, I suppose, don't look into this aspect during fund selection. Would you have any other advice that would help retail investors weather this bear market?
Yes, I think two things would be very, very important. One is that while there is a macro view that gets reflected in prices of asset classes, our belief is that your personal financial plan should be guiding all your investment decisions, either to invest in a certain place or to exit from a certain sort of instrument. So for example, if your concern is that as a result of a bear market, your industry could create some challenges on the job front, then your investment strategy needs to reflect the risk of your income going forward more than the risk of a stock market. What we have a tendency of doing very often is focusing on the uncontrollable variable, which is the stock market, because neither you nor me can control what happens in a stock market. But what we can control is how we are going to be able to generate our income. So if you feel that, for example, your company is under stress, you might want to look for another alternative. Or if you feel that the skills that you have may start to become redundant, you want to invest your money to upgrade your skills, rather than spending too much time reading about what is happening in the stock market, because it may not end up automatically helping you provision. Or even if the outlook is that equities are cheap, but your job is at risk, you want to enhance your emergency fund, because what you want to be able to do is tide over situations where equity markets are not doing well and your job also runs into a challenge. So that's very, very critical in our view for investors to think about. The second thing is that expenses on investor portfolios tend to get much lower attention in bull markets. I think in bear markets, investors should be going back to looking at their expenses very carefully. And therefore, when they've made choices in terms of buying what they've bought, they should be looking at what is their mix of passive and active opportunities, because typically passive funds will come at a much lower cost and also reduce the risk of what happens with active manager underperformance. And at the same time, if you look at the debt side, the emergence of target date debt index funds have also been able to bring down costs there. So I think it's very, very important that when returns start to become lower, you start to focus on whether you are overpaying for the sort of assets that you have. Again, don't do anything knee-jerk, but I think it's important to know where you are and what you're really doing.
So focus on enhancing your skills. If your current job is under stress, you should also have an emergency fund, and you should look to lower the cost of your portfolio. This has been a very, very interesting and fruitful interaction, Vishal. I'm sure our viewers will gain immensely from it. Thank you very much. It was a pleasure speaking to you.
Thank you so much, Sanjay, for calling me over.